You always hear about stocks, crypto, real estate, all the flashy ways people try to build a fortune. But have you ever stopped to think about what these super wealthy do to actually protect that fortune? Well, the answer might be the most boring and probably the most important secret in all of finance.
Yep, that's it. Bonds. While it feels like the rest of the world is chasing some crazy, meteoric gain, the ultra-rich are quietly leaning on the steady, predictable power of bonds. It really is their secret weapon for making sure their wealth is still there tomorrow and the day after that.
Okay, so let's get into this, because it really boils down to two totally different ways of thinking. See, most people are laser-focused on getting rich. They're chasing fast profits, taking on big risks. But once you are rich, the game changes completely. The number one goal isn't getting richer, it's staying rich.
So, to really get this strategy, we have to know what a bond actually is. I know, the word itself sounds a little stuffy, maybe complicated, but trust me, the core idea is incredibly simple.
Think of it this way. For a moment, you are the bank. When you buy a bond, you're basically giving a loan to a massive organization like the US government or a giant company like Apple, and in return for that loan, they promise to pay you regular interest. Then, at the very end, poof, they give you all your original money back. It's just a formal, fancy IOU.
And, bonds aren't some one-size-fits-all thing. You can kind of pick your flavor. If you want the absolute ultimate in safety, you go for U.S. Treasury bonds. If you're willing to take a little more risk for a higher return, you can look at corporate bonds. And if you're trying to be smart about taxes, there are municipal bonds, where the interest you earn is often totally tax-free. It's a whole toolkit.
And this whole toolkit feeds into that one core strategy. The goal here isn't to hit a grand slam. It's about never, ever striking out. It is all about preserving your capital.
Just imagine for a second, this number right here, $1 billion, is your net worth. That's got to change your whole perspective on risk, right? So let me ask you, if that was your account balance, what is your number one priority? Seriously, is it to try and double it? Are you going to go chase even bigger, riskier bets?
No way. The first, last, and only priority is don't lose it. Everything else comes second. When you've already won the game, you stop playing risky offense and you start playing an unbreakable defense.
And that is exactly why bonds are the perfect tool for the job. They give you a steady, predictable income stream. They act as a counterbalance when your risky stocks are going haywire. And with things like U.S. Treasuries, they're about as close to risk-free as you can possibly get. It's all about certainty over gambling.
And all of this leads to the most powerful role that bonds play for wealthy investors. They are the ultimate financial hedge. They are the safety net for the entire portfolio.
Now, if you want to see this in action, we don't have to look back very far. Let's talk about the massive financial crisis of 2008. I mean, this was the ultimate stress test for any investment strategy out there.
Just look at this. It's absolutely stunning. While the stock market was in a total freefall, losing more than a third of its value, something pretty amazing was happening. Panicked investors were yanking their money out of stocks and fleeing to the safest place they could think of, U.S. Treasury bonds. And all that demand actually drove the value of those bonds up. So while almost everyone else was losing their shirt, bondholders were stable. They were even making money.
So here's the fundamental principle, the big takeaway. It's not about picking one or the other. The wealthy use stocks as the engine for growth and bonds as the bedrock of stability. The two just work together in perfect harmony to build and, way more importantly, to protect wealth.
So what does this actually look like in a real portfolio? All right, let's take a little peek inside the playbook that's been used for decades to manage some serious money. It's called the 60-40 portfolio. And look, it's the bedrock of modern investing for a really good reason. You put 60% in stocks, that's your engine, that's what captures market growth. But that other 40% in bonds, that is the crucial shock absorber. It provides stability and income when things get rocky. It's not designed to make you a billionaire overnight, it's designed to keep you one for decades.
And the real pros, they take it even further. They use their super safe treasury bonds as collateral to get cheap loans. They load up on tax-free municipal bonds. But maybe the most powerful move is holding bonds as dry powder. Think about it. It's like having cash that's patiently earning you interest, just waiting. And when the market inevitably panics and stock prices crash, they swoop in and use that cash to buy amazing companies at a massive discount.
I absolutely love this analogy because it's just perfect. When everything's going great, market's up, the road is smooth, you don't even think about your bonds. They're just kind of humming along in the background. But the second that road gets rough, the moment a crisis hits, they are what absorbs the shock and prevents your whole portfolio from crashing and burning. They're what lets you survive the bumps and just keep on moving forward.
So the final question I want to leave you with is this. When you look at how you manage your own finances, are you just planning for sunny days and smooth roads? Or are you building a strategy that's resilient enough to actually weather the inevitable storm? Because that, right there, that's the difference between getting rich and staying rich.